Hey everyone, welcome back to Corporate Decoder, the place where we translate a company's financial jargon into plain English, and today we're diving deep into Ameren Corporation's latest quarterly report, a read so long it makes a tax code seem like a children's book. Get ready because beneath all those dense numbers and legal speak, we're uncovering the real story of Ameren's financial health and what it means for their future. Oh, and if you like untangling corporate mysteries, our Discord community is the place to be, linked right below. Let's get started. This is Ameren Corporation's 10Q filing, a detailed look at their performance for the 3 months and 9 months ending the 30th of September 2025. Think of it as a financial checkup, revealing how the company is doing right now. Let's cut to the chase and look at the money. Ameren reported a net income of $640 million for the last 3 months of the reporting period. That is a nice jump from $456 million a year ago. Looking at the bigger picture, for the first 9 months of 2025, their net income hit $1.2 billion, up from $975 million last year. Now, that sounds pretty good on the surface, right? It means they are making more money. This translates to earnings per S-share. For the diluted share, it was $2.35 for the last quarter, up from $1.70 last year. Over 9 months, it is $4.43, a solid increase from $3.65. This per share earning is what matters to investors holding individual shares, and a higher number is generally a positive sign. Now, let's peek at their balance sheet. This is like a snapshot of what Ameren owns and what they owe at a specific point in time. Here we see their total assets standing at a hefty $47.4 billion as of the 30th of September 2025. That is a significant increase from $44.5 billion at the end of 2024. What does this big number mean? It shows the company is growing its resources, which is generally a good sign of expansion and investment in their operations. A big chunk of those assets, nearly $38.4 billion, is tied up in their property, plant, and equipment. This is the backbone of a utility company, power plants, transmission lines, gas pipes. Seeing this number grow from $36.3 billion last year suggests they are investing heavily in upgrading and expanding their infrastructure, which is crucial for long-term growth and meeting future demand. But here is where we need to pay attention. Their long-term debt has climbed to over $19.1 billion. That is a substantial increase from $17.2 billion just 9 months prior in 2024. While growing the business often requires borrowing money, this jump signals they are taking on more debt. We need to watch if this debt level becomes a strain. Moving on to cash flow, for the first 9 months of 2025, Ameren brought in nearly $2.4 billion from its operations. That is an increase from about $1.9 billion last year. This is a really positive trend, showing their core business is generating more cash, which is fantastic news for covering expenses and investments. On the flip side, their investing activities used up over $3.1 billion. This large outflow is primarily for capital expenditures, meaning they are spending a lot of money on building and maintaining their infrastructure. While essential for the future, it is a significant drain on immediate cash. Financing activities show they issued nearly $2 billion in new long-term debt. This is how they are funding those massive capital expenditures, along with issuing $35 million in common stock. They also paid out $576 million in dividends to shareholders. This shows a company actively managing its finances, balancing borrowing, issuing shares, and returning value to investors. Let's talk about the story behind these numbers. The main reason for their improved performance this period seems to be higher base rate revenues at Ameren, Missouri, thanks to a new electric rate order. Imagine the state saying, okay, you can charge a little more for electricity. That directly boosts their income. They saw a tax benefit from revaluing some deferred taxes, which is like finding an unexpected tax refund. The absence of a big legal charge from last year also made their current year look much better by comparison. They are also selling more electricity to customers, partly due to weather patterns, which is a common driver for utilities, and partly due to steady customer growth. This increased demand directly fuels their revenue. This regulatory win for Ameren, Missouri is a big deal. It means they got approval for higher rates, which directly translates to more money coming in. This order is a key driver for their increased earnings. Think of it as the regulator giving them a thumbs up to adjust their prices to cover their costs and investments. This sentence might sound complicated, but it is a game changer for their profit figures. Last year, Ameren, Missouri had to pay a large sum to settle legal claims related to environmental issues. This year, that big expense is gone, making their current profits look a lot healthier, even if the underlying business operations haven't changed dramatically. It's like not having to pay a huge fine this year, making your budget look much better. However, it is not all smooth sailing. This is a consistent theme for many companies right now. Ameren is carrying more debt, and interest rates are higher, so they are spending more on borrowing money. This eats into their profits, even if their core business is doing well. This means some of their day-to-day operating costs are going up. They had to spend more on storm response, repairing and maintaining their power stations, and managing the trees around their power lines. These are necessary expenses, but they do impact the bottom line. Their strategy is clear: invest heavily in their regulated utility businesses. They are pouring billions into upgrading their infrastructure, aiming to be reliable, modern, and ready for the clean energy future. This shows a commitment to long-term growth, even if it requires taking on debt and significant upfront costs. This is big for Ameren, Missouri. Their power investment and service agreement policy is being extended, allowing them to continue recovering costs for new investments over a longer period. This provides financial stability and encourages them to keep investing in new energy projects. Ameren, Illinois, and its transmission arm are using a more advanced way to set rates, looking ahead at future costs. This helps them manage finances more predictably, and they are asking for higher revenue requirements, which means potentially higher costs for customers down the line, but also a better return for the company. Looking ahead, Ameren is confident they have the financial footing to maintain good credit ratings. This is vital for borrowing money at reasonable rates. They plan to continue issuing stock and managing debt to fund their ambitious investment plans, especially in renewable energy and grid upgrades. Now, my take on all of this: Ameren is clearly in a growth phase, backed by regulatory approvals that allow them to invest in infrastructure and pass those costs on to customers. Their financial performance in this report shows improvement, largely due to favorable regulatory decisions and the absence of a major legal payout. The increased capital expenditures signal a forward-thinking strategy aiming to modernize their systems and embrace renewable energy. However, the rising debt levels are a concern. While they expect to manage it, a significant economic downturn or unexpected regulatory hurdles could put a strain on their finances. Their reliance on rate increases and cost recovery mechanisms means customers will likely see higher utility bills. The company is navigating a complex energy transition, balancing investments in new technologies with the need to maintain reliable service and manage existing assets. They're large. Scale investments in renewables and infrastructure are a bet on the future, and success will hinge on favorable regulatory environments and continued demand growth. Alright, that's our dive into Ameren's latest financial report. What are your thoughts on their strategy and financial health? Let me know in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more corporate investigations. And don't forget to join our Discord community linked in the description, where we dissect these filings in real time. Thanks for watching, and see you next time on Corporate Decoder.